Hello, good morning and good afternoon from Basel. Welcome to this panel on the measurement and modeling of climate-related risks. I'm Enrique Alberola, advisor here at the BIS, and it is my pleasure to moderate this session of the Green Swan Conference. As the climate change became a concern for policymakers, there has been a sustained effort to measure and model economic and financial climate risks. In the last couple of years, the greening of the economy has moved up very, very fast to the top of the global policy priorities. There is a growing consensus around the world about the need to move fast and that policymakers have to deliver. This tectonic change is most welcome, but it brings to the fore the shortcomings of the analysis and measurement of financial risks related to climate change. The intensification of this analysis in the last decade or so has only underscored the complexity of the task. There is a widespread perception that assessment of climate risks is lagging behind. Do we have the tools, models, data, and mindset to underpin the policy and business decisions related to climate change? Do we have the capacity to assess the impact of the policies and their adoption by the financial sector? If we are aware of this limitation, how should policymakers and the financial businesses proceed? These are the issues of this session, and we have an outstanding panel of experts to address them. Some of them have a more economic and research background, while others are well versed in the financial sector and regulation. So we expect a very entertaining discussion. Let me introduce our panelists briefly. Bob Litterman, Chairman of the Risk Committee in Kepos Capital. Good morning. Carmen Reinhart, Vice President and Chief Economist of the World Bank. Thanks to both of you for being up and running so early at the other side of the Atlantic. We appreciate it. Thierry, Philipponnat, Head of Research and Advocacy of Finance Watch. Pisani-Ferry, Tommaso Padoa-Schioppa, Chair of the European University Institute in Florence, among other academic positions. Nick Robbins, Professor in Practice for Sustainable Finance at the London School of Economics. And Laurence, Tubiana, CEO of the European Climate Foundation. We have a relatively short time given the number of panelists, just a bit more than 1 hour. So I propose you to have 2 rounds of intervention with around 4 minutes per panelist in each round. In this way, we can have some time at the end of each round for a short open discussion among the panelists and to pick some questions from the audience before closing the session. The audience can place this question in the Q&A box at the left of their screen. And with no more delay, let us move to the first round. Which are the key problems to overcome and the key issues to address in the modelization and measurement of climate-related risks? I would like, if you don't mind, Nick, to start.
Well, thank you very much, Enrique, and thanks for asking me to go first. I feel very humbled with all these heavyweight thinkers on the panel. So maybe just some opening remarks on some of the problems. I suppose the bad news still is that the climate and more broadly the degradation of nature are still invisible in many of our macroeconomic models. And we have, as we know, pervasive market and institutional failures. We have problems around time horizons. We have tipping points and therefore irreversibility in some of these problems. We're faced with radical uncertainty. And I think that was highlighted most recently in the Dasgupta review, looking at the economics of biodiversity and realizing that some of these sort of the core metrics that we're using, such as GDP, are not really fit for purpose to really understand how we can pursue long-term sustainable development. So I think from a financial system point of view, that means that all assets to one degree or another across the financial system are more or less mispriced with regard to climate and nature. And we do then have a sort of structural misallocation of capital, which is meaning that we're actually encouraging, both through real economy policy and potentially financial system regulation, financial activities that are actually undermining long-term financial stability and sustainable development. So I think that's in a sense, that's the bad news. The good news, to some extent, is that some of these factors and these problems are in our hands. These risks aren't necessarily exogenous to the macroeconomic system or the financial system. We can shape them. And that I think with this increased focus on net zero as one of the goals we should be pursuing, clearly that's one of the best climate risk management strategies we have. We have increasingly roadmaps coming out from the sort of energy system, the IA's net zero roadmap. But I think that is what we're needing to see from the financial system as well, a clear sense about how we're going to reallocate capital, what are the incentives, what are the risk measures, and what are the models we need to enable that reallocation to happen. I think this is a very positive thing. We have many problems in our current economy, and actually moving to net zero is actually a net positive for the macroeconomy. We could generate an investment-led recovery out of COVID, increase the rate of investment in the economy by perhaps 2%, as my colleague Nick Stern has been suggesting. And perhaps just to close, I think one of the biggest focuses we should be playing is the so-called emerging economies in developing countries, where clearly these are most vulnerable to the impacts of climate change which they haven't caused, where financial markets are weakest, cost of capital are highest. This is a very capital-intensive transition. And in many cases, the transition will have to be very quick in these countries. In my country, the UK, we peaked our climate emissions in 1973. In the EU in 1979. China is planning to peak in 2030 and achieve net zero by 2060. So this is a fast shift in those countries. So I think the optimism is that we have a power to intervene on these risks and shape them, particularly if we take a double materiality perspective. Thanks, Enrique.
Thank you, Nick. Jan? You are muted. I think you're muted, Jan.
Very much agree with what issue in the macro model and the macro perspective. And this is due to the fact that climate was beyond the horizon, and to the extent climate was taken on board, it was through the social cost of carbon, which is also in a way extending the horizon. And what is increasingly the case now with the net zero commitment is that there is a fixed date by which we have to reach a certain target. And that turns really climate into a macro issue. It's, as the C said, it's too late, too sudden, and it's becoming a very much a macro issue. And we're having hard time finding out what are the consequences. There was a NGFS report 2 years ago, the macro modeling of climate action. Results were completely all over the place, indicating that there is no consensus on the macro implication. And actually, I disagree to some extent with what Nick just said. Let me explain why. I think to start from the nature of the shock. And for me, the nature of the shock, it's basically that it's a negative supply shock, because part of the capital stock is just not adequate to the type of economy we want to build. So this part of this capital stock has to be discarded in an accelerated way. And the fact that the transition has to be done so fast means you can't wait until the capital reaches the end of its economic life. It has to be put aside prematurely, which is a negative supply shock by definition. It's a relocation shock because also the labor capital we need to be reallocated to new technologies, new sectors. And it's a very big shock. So in order to sort of have an idea of what the size of the shock, I made a very rough comparison, comparing this shock to the oil shock. The oil shock of the 70s was roughly 3% of world GDP. The impact of the oil price multiplied with the volume of oil extraction. If we try to find out what the, it's not exactly the same, obviously, but what the size of this shock, we take the global emission, multiply by a price of carbon of 75 euros per ton, which is the price that is frequently mentioned as the target for the end of the decade. And we reach something like 3% of global GDP, which is an indication that we're speaking of a big shock. And we're speaking of a shock that requires, a fundamental retooling of our production system. Now, where I differ from Nick, and I'm going to end here, is that I very much agree with the fact that this will require additional investment. And if I take, his estimate 2% of GDP for at least a decade, and most probably more, that means a significant boost on the demand side. But that's basically to replace capital. That's not to increase production capacity. It's just to replace capital. So we're speaking of something of potential macro consequences, both because what's going to happen to the capital stock, and because we need much more investment just to produce exactly the same thing. Let me end here.
Thank you, Jean. I will let Nick reply if he wants in the discussion. And now we move to Thierry. Please, Thierry.
Thank you very much, Enrique. Well, first of all, I'm very, very pleased to be discussing with you all. It's a pleasure and an honor. I will try to address the question you asked, which is, what are the key problems to overcome when it comes to measuring climate-related risk at financial institution level? And I will base my answer on 3 principles. The big question I have is, what do we want to measure for? Because we heard many interventions yesterday talking about, the difficulties measuring and everything, and I'll come back to that. But I think the first question we have to ask ourselves is what we want to measure for. Let me give you my answer to this question. I don't think we want to measure for the sake of measuring. We want to measure because we want to act. And what do we want to act for? I think we want to act to avoid adding a financial crisis. I was going to say another financial crisis on top of the looming climate crisis. Regulators and central bankers and supervisors now all agree, typically NGFS and BIS, that climate change will have a financial stability impact. So the question is, we want to measure to avoid adding that financial crisis that we're expecting on top of the climate crisis. So this is all about managing risk. This is really about managing risk, and we have a vicious circle. At Finance Watch we like to call it a doom loop, by which financial institutions enable climate change because they provide finance to basically fossil fuel industry. And the fossil fuel industry, by allowing, greenhouse gas emissions, will strike back and in the form of financial instability linked to climate change. So in this context, we have to put things in perspective. First of all, the carbon budget is comprised of the planet is comprised between 10 and 15 years. So we have 10 to 15 years to limit our emissions in order not to go above, call it 1.5 or 2 degrees global warming, but we know what we're talking about. The other thing is fossil fuel is the source of over 90% of CO2 emissions in the world. The third thing is the proven reserves of fossil fuels on the planet is 3,000 gigatons, and the carbon budget of the planet is 500 gigatons. So what I'm saying here is that we have 6 times as much fossil fuel, proven reserves as we can afford to burn. Very interestingly, and this is essential because you're asking, what are the main problems we have to overcome? We heard, I feel, extremely interesting interventions yesterday from Mark Carney, and I'm calling Mark Carney saying yesterday that, I'm quoting here, assessing climate risk is fiendishly complicated. He also said that past data is not a good indication of future results. We heard Rosin Benham, the chair of CFTC, talking about opacity and non-linearity, And we heard Sarah Breeden from Bank of England saying the challenge to measure is absolutely enormous. We can also look at the recent and much praised, for very good reasons, ACPR Banque de France climate pilot exercise. which had a very ambitious target, and which effectively looks only at transition risk. And by their own admission, they say it in their report, with debatable and moderate, assumptions. They admit that trying to measure physical risk has not led very far. I'm quoting ACPR here. As regard banks, the exercise shows that progress made in taking physical risk into consideration is very limited. That's ACPR Banque de France talking. And they do not take at all into account what we like to call at Finance Watch disruption risk. In other words, the risk of disruption of the economy due to climate change. And effectively, disruption risk is exactly what we saw in the COVID crisis, where basically the sustainability problem creates an economic problem, which creates a financial problem. So what we're seeing here is that looking at that recent and high quality exercise from Banque de France, we could almost ask ourselves, because it comes to the conclusion that for banks and insurance undertakings, they appear moderately exposed to the risk associated with climate change by 2050. So we might ask ourselves, what is this whole Green Swan conference about? Is it much ado about nothing or very little? Because we seem to have, very little consequence. So all that to put things in perspective, and now I'll be very quick, conscious of time, to highlight the four main problems we have. The first problem we have is the data problem. We heard yesterday many times the expression data gap. But I think data gap is a nice and convenient euphemism, but it is also a very dangerous one, as we do not have a data gap problem. We don't have the data, full stop, and we'll never have it, which is normal as we have a forward-looking event ahead of us. So we don't have the luxury of having data. In other words, what I'm saying here is that not only we don't have the data, but when we have it, it will be too late. So that's the first thing we have to say on data. The second thing is, but I already mentioned this, so I will be very, very quick. We have a risk measurement problem. Supervisors can only measure transition risk, and if that, with very debatable assumptions. I just mentioned it in the case of Banque de France, but it's exactly the same for EBA, EBRD, ESMA did something, and CBCS did something as well recently. And they're all saying, look, our assumptions are weak, and we know it. Physical risk, we don't know how to measure because we don't have the data. And the biggest of all risk is neglected. That's the risk of disruption to the economy, as I just mentioned it, which is nonlinear, it's unpredictable, and it's abrupt. The third problem we have is the dynamic balance sheet assumption that all supervisors are taking. What is the problem with that? Basically, this assumption says we have time to adapt. So we banks can always stop financing the economy. We insurers can always stop insuring the economy. So you take the dynamic balance sheet assumption, and then we'll stop when we see that things are starting to degenerate, and therefore we don't run a risk. But when you think about it, this feeds a global macro prudential problem, because when all banks stop financing the economy and all insurers stop insuring the economy, well, we don't have an economy anymore. And when we don't have an economy, everything collapses. So this dynamic balance sheet assumption, which I understand very well from a technical standpoint, may be logical and coherent from a micro-prudential standpoint, but in my view, should be debated from a macro-prudential standpoint, as it defines the purpose of those exercises, in my view. But the most fundamental problem of all we have is that central bankers and supervisors are in the paradoxical situation where, on the one hand, they say they need to quantify the risk to come up with concrete solutions, and at the very same time, they recognize that they do not know how to quantify the risk. And I just give a number of examples on that. Interestingly, yesterday we heard Rosting Benham say, addressing risk, and I'm quoting here, addressing risk and regulating simply does not work. And Luis Pereira da Silva, in a speech last year, said very interestingly that less improvement in risk modeling and more for decisive action and immediate action is what we need to do now. So effectively, solving the problem we have is solving that paradox that we're so used collectively as a system to quantify first to find a solution, when effectively now we don't know how to quantify this, and we don't have the luxury of waiting. So I'll stop here.
Thank you, Thierry. Laurence, it's your turn.
Thank you. Again, as others, very happy to participate to that very crucial discussions. I like very much how Thierry has put this forward as, in a way, the potential apparent trade-off between having the data, having the ability to measure the risk, and in a way, just delaying action, and that has been, in my view, and looking at all the long discussion between economists, micro and macroeconomists around the climate change issue, as probably something who has not helped enormously into designing, facing the risk for real. And I'm struck by the fact that now, of course, the financial community is better and better at trying to understand the risk for the portfolio, the stranded asset elements, etc. But not so much on how the behavior of all financial institutions are in a way maintaining or even increasing the climate risk, the impact on, of course, the transformation of the economy that has to happen. And that's why I think, there is clearly a problem there. And as we see any problem, meaning for example, the economic and social crisis that is now looming and potential financial one because of COVID, we see immediately the idea that climate action, and as many of you said, we don't know exactly how it will happen and the disruption of the economy. So it's better to delay action because we don't know how to reduce the cost effectively. So this is, in my view, a major problem for the contribution of the economic, profession to this, facing the net zero challenge by 2050. The second element is, of course, the macroeconomic model had a lot of difficulties, even if there are now some attempts to address that gap or that failure, to understand the physical transition and for example, the industry transition, the dynamic of this transformation in terms of technology and other elements of this, of course, long-term vision, which of course is about the replacement of the actual economy with another one, is I think a really, again, a problem of certainly tools, and certainly the second part of the discussion will address that, but at the same time, a problem of mindset. And that's why I think I totally agree with what you just achieved. We need to recognize that we don't have the data. We may not have even a solid capacity to, articulate this macroeconomic modeling with, what could be the engineer modeling of, for example, energy transition, and to know how to be a zero emission power by 2030, 2035, like Biden has decided, for example, for US, and at the same time, and if we don't know how to do that, at least begin, in a way, having a sort of precautionary approach to, again, giving the right signal to the economy without knowing exactly what the cost on the GDP, on the economic growth will be. And that, I think, many brilliant economists, and fortunately Martin Weissman was one of the probably leading understanding that we could have very, very low probability, but very high and disruptive elements. We are now showing that these disruptive elements are probably more frequent or can really happen. So I think it would be really great to send the signal that just focusing on the risk for the financial community would be in a way to just turn around and say maintaining traditional behaviors would not allow the transition, and this is, even we cannot measure it and we don't know when climate will disrupt the economy, has to happen as soon as possible. So I don't know if the solution will be the modeling, because again, that's the physical cost of the climate risk and impact, even if the IPCC and everyone is trying to produce more data, we know that we really cannot measure that potential disruption. So I would say the change of mindset, in my view, knowing that we don't know where the tipping point are for many of the assets and on the different economic sectors, would be in a way to recognize just the fact that we have to reduce emission drastically, and we may not find the best optimized trajectory to do that. Thank you.
Thank you, Laurence. Bob?
Thank you. First, I want to echo the many speakers here who have noted the important moment we're at today in terms of addressing climate change and the role of the financial sector. I totally agree with Thierry that the risk management approach is really a very important framing. And, you know, the folks in the financial community have a lot of expertise in risk management. The best science shows that damage from climate change is already serious and could range in the future from severe to catastrophic. Global financial regulators, therefore, have a responsibility for addressing emerging financial sector risks and vulnerabilities before they trigger or amplify a financial crisis, and climate change is clearly such an emerging risk. And risk of this magnitude demands an immediate, ambitious response, including strong globally harmonized incentives for the private sector to reduce emissions. Unfortunately, many governments have not responded adequately, and thus today we have many different incentives in different jurisdictions, strong in Europe and weak in most other economies, and even worse, significant subsidies to fossil fuel production and consumption in many parts of the world. The current administration in my country, the United States, is taking an all-of-government approach to address climate risk, and financial regulators here have moved to join the global response. However, we do have to face the reality that the U.S. Congress has not yet priced carbon, and thus the United States is not yet managing its climate risk appropriately. Moreover, this risk management failure is extremely dangerous because it contributes to the lack of ambitious, coordinated global response. Financial risk management has several simple principles that apply to managing climate risk, but let me remind you of three of those. Most important, risk managers must look at the full distribution of potential future outcomes. Risk management requires imagining and designing policies to prevent extremely bad but plausible scenarios. Identifying those scenarios, however, is especially hard for climate risk because we're performing this experiment for the first time. Unlike typical financial risks, we do not have a relevant history with which to draw scenarios, and unlike typical financial risks, the relevant time horizon must cover decades of increasing hazards and impacts determined by actions taken today. For all these reasons, financial sector market participants, including systemically important financial institutions, are looking to global regulators to provide leadership in developing globally harmonized transition scenarios that can guide disclosure of material climate-related risks in ways that inform relevant financial risk management decisions. Another principle of financial risk management, which is perhaps not as obvious, is that our objective is not to minimize risk, but to price risk appropriately. The fundamental source of climate risk is, of course, the lack of appropriate incentives to reduce emissions. It is not, however, the role of financial regulators, nor within their authority, to create the incentives that will lead corporations to reduce their emissions. Moreover, financial regulators do not have the tools required to do so. Climate risk management and disclosure is important, but disclosure alone does not incent emissions reduction. A third principle of risk management is that time itself is a scarce resource. If we have enough time, we can solve almost any problem. It's when time runs out that a risk can lead to a catastrophe. The existential risk from climate change is increasing as we fill the atmosphere with greenhouse gases. There is a wide recognition that financial markets need to finance the rapid transition to a net zero economy. The scale and urgency of that transformation requires that financial markets immediately and dramatically direct the flow of capital toward investments that will reduce emissions. But capital flows in the direction of expected opportunities to make profit, given the incentives that are in place and expected to be in place in the future. Although incentives to reduce emissions are not globally harmonized today, for long-lived capital, expectations of future policy are much more important in directing the flow of capital. And while those expectations are not directly observed, changing valuations of capital assets in recent years do reflect that those expectations are rapidly changing. Thus, it's very important that those changes in expectations accelerate and are realized. And the most important and urgent climate risk management imperative is that governments move quickly to set strong, harmonized incentives to reduce carbon emissions. The lack of appropriate incentives to reduce emissions is the fundamental source of the problem, and without global action to put a price on carbon, the existential risk created by climate change will continue to grow. Time is rapidly running out, if indeed it is not already too late. Thank you.
Thank you, Bob. And we close this first round with Carmen. Carmen, go ahead, please.
Well, thank you. It's been very, it's been fascinating to hear the various views, and the title of the session on measuring climate-related risks in macro and global terms. It covers a lot of ground, right? Because we are talking, when we say climate-related risks, we are talking about a lot of very different moving parts. Jean mentioned the supply shock element associated with the transition. I deal with small governments that are hit by tropical storms and anticipate being hit much more frequently and perhaps much more severely. The types of degradation and the risks associated with them, do take on very different complexions when you're talking about drought risks, or you're talking about, so the climate umbrella incorporates a great many risks. Now, having said that, I think the two areas that I will focus on is and they're interrelated, as Thierry and Robert and other speakers have highlighted. The issue of financial sector risk is one important dimension, and the other one is fiscal risk, and they're interrelated, obviously, because private debts after a crisis become public debts, and the interconnection between financial risks and fiscal risks is a strong one, and it's a very important one also for a lot of the emerging markets and developing countries that are going to be bearing the brunt of perhaps some of the more imminent fallout from climate-related risks. So there's a great deal of heterogeneity on the types of risk. There's also a great deal of heterogeneity in how imminent they are. And, I think I've more, I probably take some issue with some of the views expressed that this is sort of a very long, drawn out, long horizon issue. Well, some of it isn't, actually. Some of it in terms of low-lying areas, sea level rise, and the incidence of tropical storms and the like. Those are a lot more imminent. And what I would say is, well, on the question of data, and realistically, when we look at some of the problems we have in macroeconomics in assessing risk wouldn't be risk if we were capable of measuring. It wouldn't have a variance. This one has a particularly high variance, but it's addressable in the context of regulation, supervision, and it's addressable in the context of planning in terms of fiscal planning to incorporate. And I know the second part, so and to stick to my 4 minutes, the second part we will address the issue of solutions. But we do have tools that are applied to other types of risks that obviously are, you know, not going to transfer smoothly. But you know, I think the financial sector risks and certainly the fiscal risks, you know, we do have tools on how to evaluate given imperfect data, and you know, even in the case of longer horizons, we do have tools to help assess those. I mean, it's I guess something I'll leave for our second part of the discussion on some of the solutions.
Thank you, Carmen. Thank you all. Well, this is the first round. It was about problems, so complicated things, but as you spoke, you added risks and ability to address them, so it all become a bit more gloomy. Nick started on at the end a positive note, and then he was slashed by Jan. So this is not a very, but we hope in the second round with the solution we find a way of optimism. Now we can open a very short part for discussion. Maybe Nick, you want to reply to Jan on the point he made?
Yeah, no, I think that's really it's interesting to hear Jean's estimates. And again, I suppose in terms of the energy shocks, and this is a historical precedent we've seen. I mean, that happened over a number of decades. They were punctuated 73, 79, and so on. And that's what I think is actually striking. If we look at when particularly European countries peaked their emissions, it was in the 1970s, and we can think why. It was partly energy price shocks and much broader issues about industrial restructuring and so on. So before climate. So I think we do need to think very clearly about this stranding, both at obviously the asset level, financial system level, and the wider issues. And I maybe just to underline what Carmen's been saying is that we shouldn't get sort of fooled by the 2050 focus, that actually the major issues need to happen this decade. Certainly in the work I've been doing in terms of the capital reinvestment on the net zero side, this needs to grow fivefold. I mean, this is looking at the UK, my country. But this is a very rapid growth that needs to happen this decade. So I think we need to sort of bear the long term in mind, but so we accelerate action this decade. And recognize that is going to be a disruptive process, but the sort of risks we've heard already will be far more catastrophic. So maybe if I could end there. Thank you.
Any other who wants to chip in or commenting other points of your? No, Jan, and then Thierry.
Yeah, I think we basically agree. What I wanted to say is that, you know, very often this investment that's required by the transition to a carbon neutral economy is analyzed with a sort of very naive Keynesian framework, assuming that it's just more investment or more jobs, etc., perhaps some reallocation difficulties, but fundamentally easy macro development. I think it's not. I mean, you have to look at both sides. You have to look at the supply side, and basically what it's telling us is that we have to, you know, invest much more just to get the same level of output, which means constraint on consumption, constraint on income. And this is not a trivial amounts we're speaking of, not by far. And that's what I wanted to say with my comparison.
Okay, Thierry, you wanted to say something?
Yeah, thank you, Enrique. Perhaps I wanted to comment on two things that were said, first by Laurence and then by Bob. Laurence said, in my view, something very important when she said precautionary principle. You know, can we sit here idle, waiting for illusory quantifications, something that will happen perhaps 10, 15, or 20 years from now when we have a carbon budget of 10, 15 years? Well, you understand exactly where I'm heading. And precautionary principle should be the source of our decision-making process. And we'll come back to that in the solution part of our discussion, but I think this is absolutely fundamental. And that principle exists in all jurisdictions of the, well, maybe not all, but in many jurisdictions, and certainly in the Western world. Another thing is what Bob said. Bob said two things which, in my view, are very, very important. First, he said, it's not about, let's not have any risk. It's about pricing risk appropriately. And this is what risk management is about. Do you assess your risk properly? And do you put the right price on your risk? I'm not saying that, I'm not a believer that, the invisible hand is going to solve everything. But if you don't do that, you have no chance, you don't stand a chance of getting things right. So, and I'll come back to that in a few minutes, but this is very, very fundamental. And I would say philosophically, we're really, and we didn't coordinate with Bob before this session, but we're really on the same page. And the other thing he said, I could not agree more with, is when he said that disclosure alone does not incent CO2 reductions or CO2 emission reductions. Disclosure is fine, it is necessary, it's a useful tool, but believing that disclosure is going to save the day just doesn't work. It is not in the nature of private actors to, just because they've disclosed, to solve public good issues. This is a public good issue. And a private actor doesn't have a mandate to solve a public good issue. So yes, you need to disclose in order to have the information. Yes, by all means. And certainly, I'm spending a lot of time on trying to get the framework for disclosing right. But so indispensable, let's continue doing it, won't be enough. And then sometimes you feel that people think, once we've done it right on disclosing, transparency, right information and everything, job will be done. No, it's one brick, but it's not the only brick.
If I may, Enrique, just building on what Thierry just said, one, we have even the proof of that, where disclosure, and a number of companies have done that relatively early, like, for example, the big insurance company like AXA in France. They just very, very frankly and genuinely said that, yes, disclosure happens and doesn't mean any change into our investment policy. No connection. For obvious reasons, just Thierry, that transparency doesn't mean that you would, in a market where still the dominant behavior is to, in a way, allocate for the moment a very small part of the investment, whether equity or bonds, to the green factor. So there is no reason to be afraid of disclosing and, in a way, continue with, of course, profitability on the fossil fuel activities. I'd like to come back to Jean's point, because I do think he's right. The idea that we present this picture with, of course, more investment, more job, a good multiplier in the green activities doesn't finally, it's there. I think I totally agree. It could be even a naive presentation where if you don't factor the destruction of capital that is happening very, very quickly. When you look at the coal sector, in many countries of Europe, the loss of value on the utilities in the coal sector has been really, really rapid in the 10 last years. And of course, the cost of this is now, of course, factored in by many governments and, of course, many private actors. So there will be a value to combine the two facets of the coin, which is we will have to pay for that stranded asset. Somebody has to bear the cost of the destruction of that capital, the quicker amortization of the capital, for example, invested in coal, but invested in oil and probably very soon in gas. But then we cannot lose as well the capacity of understanding where the job can be created and how. So I see it's a sort of, it's a discussion that cannot happen now. And of course, the green movement or the green economists are saying, look, there is a lot of jobs that have been created, for example, in the automotive sector, even if electrification could destroy a number of industrial capacity and jobs. But that, in a way, it's not a consistent discussion. So, in a way, in the solution, at least in the assessment of the economy, I think it will be more honest to understand that there will be a cost on the two sides. I mean, investment, a positive investment in green, but compensating and absorbing the loss in the capital structure of the stranded assets.
Carmen, very quickly, so we can move to the second round.
So, following up on Laurence, and going back to the earlier point that I made, that there's a variety of risks. In the transition, significant sectoral changes have balance sheet consequences. Some of the most overextended industries are in fuel-related areas that we are going to be facing down on an accelerated schedule. There are balance sheet consequences. Those are part of the risk. Those go over and beyond some of the other risks that we've been discussing. It's connected to Jean's comment about the supply shock. This is the balance sheet side of that. It's always, when we're talking about risk, it's always critical to assess who will be illiquid during the transition and who will simply become insolvent in a new regime. That's part of the risk. But I have a lot of sympathy to what Thierry said. That I tend to view some of the mispricing issues very much like some of the other kinds of mispriced risks, for example, that we see connected to financial crises, that an individual firm or corporate may find it very attractive to borrow short term. But if every company borrows short term, the probability of a financial crisis increases. So we have to find a way of them internalizing through regulation, taxation, or a variety of other macroprudential tools of internalizing those risks. But I think, when, again, just to repeat the message that the range of risks that we have to price are, very, very heterogeneous, is that in and of itself is very different from when you talk about other risks. When people say currency risk, you kind of know exactly what they're talking about. When I hear the word climate risk, so many things come to mind.
Thank you, Carmen. Let's move to the second round. It's just 27 minutes, and we still have the solution, which is also like to, in the audience, would like to hear from you. Which solution do you specifically propose to these problems, and how would you implement them? Let me start now with Laurence, please.
So I think we have been thinking about how to have more credible analysis, but that doesn't prevent action. I'm keen that it's on top of my mind now, and probably because of the preparation of Glasgow and this the enormous wave of commitment for these net zero emission targets, where very different actors are taking that commitments. And I think it's, in particular in the financial community at least, I think it's rather confusing. And we don't know exactly what is really happening. Is there any reality beyond, in a way, feeling or imagine that a solution will happen because of offsetting emissions somewhere, or so I do think we are in a world where at the same time many financial institutions are committing to really get their portfolio with this target of net zero emission by 2050 or before. And at the same time, the reality of this commitment and then the signal to the market is very, very confusing because it may, it may cover very, very, as Carmen said, very different realities. And so my first thing would be, at least we cannot, again, not coming back to our previous discussion, we cannot anticipate nor the disruption risk, nor probably the real cost of the transition, but we have to do that. And maybe that's the first time, in a way, this community of economists should not look for the optimization of the trajectory, but decide that we have to do it anyway. But at the same time, we need information, not so much because this information will provoke change in the behavior, but because transparency and the reality of this net zero commitment, I think is essential for the credibility of the system. And, having worked a lot, of course, on drafting this Paris Agreement, there is no enforcement mechanism beyond shaping expectations. And that's in a way, organizing a self-fulfilling prophecy. And if really the commitments and there is no credibility in this will just not happen, meaning the potential climate risk for the financial committee will not be considered seriously. In my view, that's why still the investment in the fossil fuel sector are so high, notwithstanding, of course, the public subsidies, which are still very, very high too. So first, I would say, even if it will not make a big impact, we need credibility. And in a way, it's not, again, disclosure, but it's credibility in really what the different actors can do and what they do for real, in particular in the financial institution. And if not, we will see a backlash that finally will, again, delay many more action. The second element is there are attempts to couple macroeconomic modeling with a view of understanding the financial constraints. And maybe there is a capacity to articulate the thing we know better, because now we know better the cost of technology and how to change, for example, to go for net zero steel or net zero cement, or the transformation of the automotive sector, to go from the engineer model to the macroeconomic model, as I mentioned earlier. So I do think that I would insist on the credibility and accountability, and there is no accountability mechanism for the moment. And I may overstate that, but I'm feeling if there really these commitments are flourishing from many actors, from the central bankers to the private investor, to the asset owner alliance, etc. This signal will in a way be losing more and more its efficiency in a way as an incentive. And finally, for the carbon pricing we have been discussing in the first round, I do think there is a value, because we know that the policy set and the policy measures will be different and are kept different. We just recognize a political economy in the US, but that could be the same now that, for example, Europe can want to increase the scope of the emission trading system to other sectors. Then I think a force could be really to reveal the implicit price of carbon in all societies, and in a way to begin to discuss the problem of the level playing field between these different regions and the different, in a way, elements of the policy measures. But again, waiting for a global carbon price, which of course is like a graal, will not happen, at least now. And this will be absolutely too late. That will be too late. So I would say that improving and in a way disclosing and working on the implicit price of carbon everywhere, and like what OECD have been doing, could be at least a level playing field, part of the discussion between the different financial actors and the government side. Thank you.
Okay, I think Bob has an answer for that.
Thank you. Yeah, I have two suggestions for potential contributions. First is relatively straightforward. As climate risk increases over time, corporations, investors, and other financial institutions will need to develop the capabilities to measure, manage, and disclose those climate-related risks. And in order for those individual analyses to aggregate so that banks, insurance companies, investors, and asset owners can understand the total climate risk in their portfolios, the metrics should be based on common underlying assumptions of macroeconomic data, including scenarios for carbon prices, as well as common methods of analysis. It will also be helpful to have common scenarios across different regulatory jurisdictions so that each company does not have to create multiple analyses and disclosures for different regulatory regimes. Thus, it could be very helpful to have a common, shared, public, and transparent open source repository for data relating to physical and transition risks, as well as a platform for accessing and analyzing that data and communicating the inputs from and results to the appropriate regulatory bodies. This is the vision of OS Climate, a collaboration community uniting under the auspices of the nonprofit Linux Corporation Foundation in order to build a software platform that will boost global capital flows into climate change mitigation and resilience. This project is currently moving forward with many leading financial, data, and technology companies working collaboratively with financial regulators and providing resources and governments. I'm very pleased with the progress to date. The second suggestion I have is to create financial instruments that will more clearly reveal market expectations of future carbon emission prices and will also allow hedging of emissions pricing risk. One relatively simple approach to that would be to link the future coupons of a sovereign bond to a comprehensive measure of the then effective carbon price in that jurisdiction. Such an instrument, with a structure similar to an inflation-linked security, could reveal market expectations of future carbon pricing, just as inflation-linked securities today reveal expectations of future inflation. At my firm, we have been researching marginal incentives to reduce emissions across different countries and over time, and we were struck by the lack of a current comprehensive measure. In addition to the obvious incentives in carbon taxes and cap and trade systems that exist in many countries, but are typically much too small, we found that there are other important incentives to account for, embedded in, for example, gasoline and other fossil fuel taxes, as well as many types of subsidies to fossil fuels, as well as solar and other renewable energy. Indeed, we found that gasoline and fossil fuel taxes, though usually not designed to reduce emissions, are by far the most prevalent and significant incentives. In fact, when we look at a comprehensive measure of policies across countries, we find that there's a wide range of net incentives. In our most recent data set for 2019, the largest incentives to reduce emissions were in Europe, with the highest individual country being in France, where the incentive was over $100 per ton. In the United States, we estimate about $18 per ton, and the global average is about $13 per ton, with net subsidies in the Middle East, the largest of which was in Iran, which had $128 subsidy per ton of fossil fuel emissions. Not surprisingly, those countries with the strongest incentives have reduced their incentives more quickly and have lower carbon intensities in their economy than those without. And countries with subsidies increase emissions. If a sovereign were to issue a bond with coupons that are linked to the carbon price, for example, a higher coupon will be paid if the then existing carbon price is below a target, and a lower coupon will be paid if the carbon price is above the target for that date, then the bond would be green in the sense that it would incorporate an incentive for the issuer to hit its target price. For the investor who owns such a bond, it provides a hedge against the risk that the sovereign does not meet its target price. In addition, such a bond would allow the sovereign to signal its future intentions with respect to carbon pricing. And finally, by comparing the prices of standard sovereign bonds with those of a green carbon price linked bond, the market would reveal the forward curve of expectations for carbon pricing, a key driver for the flow of capital toward the net zero emissions economy.
Thank you, Bob. We are running a bit behind. Can you stick to the 3 minutes, Nick?
fascinating to hear from Bob, and I think this idea of sustainability-linked sovereign bonds really good idea, linking it either to price or carbon emissions, or, for example, in some countries to deforestation. So I think we are limited in time, and I think particularly thinking about what we need to do this year to really manage these macro risks that we talked about. We've got the positive move, the voluntary moves within the financial sector, the GFANs, the 160 trillion signed up to net zero. I think there is a missing piece within the financial system, which is the role of central banks and supervisors. This is what we call sort of net zero central banking. And I think there's some practical steps that this community on this call and being organized in this great Green Swan event can take. Very clearly set out in terms of strategy, their view about how they will be dealing with the net zero challenge from a risk perspective. So we discussed on this panel, this is a fundamentally risk issue. Net zero is a risk mitigation trajectory. Thinking about refining our scenarios and stress tests, particularly having a 1.5 degrees stress test. And actually something we've advocated is actually thinking, and particularly this moves into the prudential area, thinking much more about what banks and insurers and investors are doing in the next 5 years in terms of their capital allocation decisions. These are crucial in terms of issues. Prudential, clearly, there are ways within the prudential framework that we can alter the cost of capital so that this incorporates the carbon risks in particular we've been talking about, and also change the expectations of particularly regulated financial firms so that actually they are in line with the global goal of net zero. And that's why we think that prudential supervisors should require regulated financial firms, banks, insurers, investors, pension funds, and so on to submit transition plans. And that would be a way of ensuring that there was a credibility and a consistency and integrity to these transition plans as they come forward. Clearly, monetary operations, very important to think about incorporating the carbon risks in terms of actually the purchase of assets, corporate assets. Interestingly, obviously sovereign assets, which goes back to Bob's point. And then there is potentially a point which hasn't been raised so far, which is the role of central banks and supervisors thinking through some of the distributional consequences that this transition will make. I think Jean and Carmen have made very profound comments about the speed and the scale of this. And I think clearly that role in delivering a just transition stands with governments, with fiscal authorities. But particularly, I think we can draw out where are there some particular sector or regional concentration risks from these stress tests that are happening. And therefore, where do we need to place more fiscal and policy effort to ensure that not only do we not have people left behind, but also that we don't have the pushback that could happen against this very necessary and very disruptive transition. Thank you.
Thank you. Carmen?
So let me pick up where Nick left off. So I'd like to make 3 brief points that are concrete on what can be done, and also this picks up on Robert's point about green finance and just rethinking about contracts, debt contracts themselves. You know, where Nick left off, at the end of the Asian financial crisis and then after the global financial crisis, we first really introduced the FSAPs, the financial sector assessment programs, and then we strengthened them and expanded them to be more mindful of you know, off balance sheet and all kinds of hidden risks that and it, you know, worked a lot more to have more encompassing and realistic stress tests and so on. I think the mechanisms to incorporate climate risks on balance sheets, the mechanisms are there and can be adapted. So you know, there's no reason why FSAP can't involve stress testing of the particular institution or group of institutions in question for you know, different scenarios that relate to climate, either to changes in climate or to the transition issues that we've been discussing which would, you know, shift the risk profile of you know, at the broadly defined energy sector. So the FSAP moving to FSAP plus is the parallel to that, which is very relevant to the work of the IMF, the World Bank, on debt sustainability analysis. And that's already actually starting to be done. Because, you know, a devastating hurricane, you know, has really the kind of impact that could make or break government debt sustainability in many of the countries facing these shocks. This is not a new phenomenon, but it's one that is becoming increasingly likely. And so incorporating in the stress testing, and in some countries actually in the baseline, climate-related risks is also another way of dealing with our aim to better integrate this kind of risk. I'd like to go back to Robert's point, which I'm completely, I think green finance, in terms of there is a real appetite for there is a shortage of capital flow. There's a chronic historic issue of why doesn't capital flow from rich to poor countries, and finance can be green finance can be a catalyst, but we have to think about the contracts. And on the note of contracts, you know, not in view of, but in addition to the issues that Robert brought up, there's the issue of force majeure clauses that are going to be increasingly, I think, necessary if you're dealing with especially small states that are particularly vulnerable already to climate risks. And finally, and I'll stop here, I think on a recommendation which is very much in line with some of the, you know, pause and the points made by Jean, that, you know, we are replacing, you know, it's investment being replaced. It's not, you know, in addition to that, there are transition costs. I think being sober about presenting the transition is very important to avoid the kind of overselling that I think economists were importantly responsible for on globalization. Those that stand to gain are many, but those that stand to lose a lot. They're fewer, but they lose a lot. And so I think the issue of not overselling is important actually for credibility and for, you know, avoiding backlash as was the case and has been the case with globalization and inequality.
Okay, thank you. Jean?
First is to emphasize really what was said by several already, and very, very eloquently by Robert, about the cost of the low credibility of the climate policies currently. I mean, to me, it's an absolutely major risk. I mean, the risk of a policy reversal is strong. I'm speaking, you know, I'm from a country that already twice went back on projects to introduce carbon taxes, one on transport and then the general carbon tax. And I think we're facing this risk everywhere because of the social consequences, the economic consequences of being serious about climate. So what can be done? I fully support what Robert said about, you know, revealing expectations that are in the market. I think that's a strong signal that's needed, and maximum transparency is needed. Ideally, we would wish also governments to have skin in the game, so to have actually, to sell options to the private sector, so that if the government backtracks on its commitments, the private sector could actually be compensated. So that's my first point. My second point is to emphasize one dimension we did not discuss, which is a spillover effect of climate policies. I'm speaking from the EU this time. The EU has absolutely major plans to transition to a carbon neutral economy. This will have major spillover effects on countries that are actually supplying the EU with fossil fuels. And we can't just overlook the consequences for countries like Algeria, including Russia, including the Middle East, including Azerbaijan. I mean, and consider that we're doing our policy, then it's for them to deal with the consequences. This is not going to happen. So I think the external dimension of those policies is something we have to take on board.
Thank you, Jen. And to close, Thierry.
Thank you, Enrique. Well, I certainly sympathize with many of the proposals, not all the proposals made by other speakers, but conscious of time, I'll go back to the logic I emphasize, which is a risk-based logic. And the good news when it comes to talking about solutions is that we do have a solution. The solution is very simply take potential regulation for what it is, a risk-based tool. And if your risk-based tool is not calibrated properly, effectively you're incentivizing, the wrong risk to be taken at the wrong price. Okay, so this is not a question of supporting factors or penalizing factors. Far from it. Forget about that. Just use prudential regulation for what it is, a risk-based tool. And the other thing is, having recognized all the difficulty of quantifying, measuring, first part of this discussion, if you cannot quantify, use a qualitative approach. Use your judgment. And let me tell you how you can use your judgment. Two very simple principles. The first principle is that prudential regulation should be in coherence with itself. Whether banking or insurance regulations have special articles, I don't have the time to dive into the detail, saying if a risk is deemed particularly risky, please apply in the Basel framework a risk weight of 150%. In the insurance Solvency II logic applied in the EU and for obvious reasons in the UK as well, apply 100% capital charge. Well, don't tell me that in a stranded asset context, fossil fuel exposures are more risky than private equity or immovable property. This is not true. So please put your prudential regulation in coherence with itself so that at least you have something consistent. And the other thing is, for new exposures, let us not forget what the IEA, the International Energy Agency, told us 2 weeks ago. New investments in all fossil fuels must stop immediately. Okay, translate that into financial jargon. This is a free economy. You're a financier, you still want to finance new fossil fuel exposures, fine, do it. But all financiers know that if they're doing something extremely risky, they should fund it out of equity. I mean, a very simple risk management principle. You still want to do it, fund it out of equity. So, whether in banking prudential regulation or insurance prudential regulation, apply the right capital charge so that it will be fully equity funded. And this is completely coherent with what the IEA is telling us. So we do have a simple solution. We have a problem, we've recognized it. We have a very simple solution. When I say simple, it doesn't require constitutional or treaty changes. It only requires the will of policymakers and legislators to do it, amend a few articles in prudential regulation, and it's done. And then we will have addressed the question of, financial stability implied by climate change. So, up to our policymakers and legislators to do what they should be doing.
Okay, thank you. We have arrived to the end of our time. So I think, unfortunately, there is no time for questions from the audience or discussion among you. But, there's a lot of food for thought here. I want to thank you for your interventions. You also keep a dialogue, which is very useful for the audience. And now I would invite you and the rest of the audience to move to the next session with Joe Stiglitz in the plenary session. So thank you very much, and thank you for your collaboration.
Thank you so much for this most interesting debate.
Thanks, everyone.
Take care.
Thanks. Bye.
Bye-bye now.
Bye.